Welcome, everyone. As your lead analyst, I am absolutely thrilled to share this explainer with you today. We're going to dive right into the absolute foundational physics of how we value our company's projects, potential acquisitions, and ultimately our own equity. Because let's face it, if you want to understand how the market prices our future, you really have to understand the time value of money.
Here's our quick roadmap for today. We're covering the value of time, the anatomy of interest rates, the mechanics of compounding, unequal cash flows, growth rates, and finally Gordon growth. All right, Section 1, the value of time. Let's start with the literal cornerstone of all finance, present value versus future value.
To really grasp this without getting completely lost in the math, I want you to think of a single dollar today as an apple seed, right? If you have that seed right now, that's your present value. You can go out and plant it in an orchard. Over the next 5 years, it grows into a tree and you get multiple harvests of apples. That is the earning capacity of capital deployed today. On the flip side, if someone just promises to give you that exact same seed in 5 years, your future value, while you suffer a massive opportunity cost, you have literally lost 5 entire years of harvests. So $1 tomorrow is fundamentally worth less than $1 today because of those lost harvests, plus the risk that the guy might never actually give you the seed, and inflation making apples less valuable anyway. We absolutely must account for this in every single model we build.
So, how do we actually calculate these future harvests? Well, our future value is basically our present value multiplied by our growth engine, which is just 1 plus our discount rate, or R, all compounded over n number of years. We aren't just adding interest here. We are earning interest on top of our previous interest. But, this entire equation hinges on one absolutely critical, highly sensitive variable, and that's R, our discount rate.
That brings us perfectly to Section 2, the anatomy of interest rates.
Now, what's really interesting here is that this discount rate isn't just some made-up number we pull out of thin air. Think of building an interest rate like building a highly customized insurance policy. When you commit your capital, you're taking on multiple layers of risk. So as an analyst, you literally stack distinct risk premiums on top of a baseline risk-free rate just to compensate yourself for those specific hazards. So when you see the nominal rate in our models, it's actually a combination of things. It equals the real risk-free rate, which is your pure compensation for just delaying your gratification, plus expected inflation. Then we start stacking those specific asset risks. We add a default risk premium in case the borrower goes belly up, a liquidity premium in case the asset is super hard to sell quickly for cash, and a maturity premium, because locking up your money for 30 years is way riskier than locking it up for 30 days. Every single time you see a discount rate, just remember it's a giant composite of all these economic fears and expectations.
Moving right along to Section 3, the mechanics of compounding. Let's look at how this actually plays out, because the rate you're quoted is almost never the rate you actually take home. Let's say a bank quotes you an annual rate, but they compound your interest daily or monthly. Your actual yield is going to be higher. To find your true real-world yield, we calculate the effective annual rate, or EAR. You just take the stated rate, divide it by your compounding periods, raise it to the power of those periods, and subtract 1 to strip out the initial capital. This gives us the true annualized growth of our money when it's constantly being reinvested. But wait, what if we compound infinitely? What if interest is added not every day or every hour, but literally continuously, every single microsecond? It's kind of like a snowball rolling down a steep mountain, picking up microscopic flakes of snow at every fraction of a second of its descent. To model this, we use the mathematical constant E. So, future value simply equals present value times E raised to the power of our rate times time. And this right here brilliantly illustrates the insane power of compounding. If an investment has a stated annual rate of 12%, but it compounds continuously, that snowball effect means your actual effective annual rate jumps to roughly 12.75%. Now, 0.75% might sound like tiny potatoes, but compounded over a decade on a multi-million-dollar corporate project, that fundamentally alters our capital allocation decision. Okay, Section 4, navigating unequal cash flows. It is time to leave the neat, theoretical, textbook world of perfect lump sums and step into the messy reality of corporate finance. In the real world, our projects usually look more like this. Year 1, we generate 10 grand as we launch. Year 2, boom, we hit peak sales of 50 grand. But then in year 3, a competitor swoops in and revenues drop to 5,000. When project revenues are erratic like this, we absolutely cannot rely on simple, clean annuity formulas. You just can't treat this like a predictable monthly mortgage payment.
Instead, we have to treat every single cash flow as its own isolated event. We calculate present value by taking each individual cash flow, discounting it backward by our required rate over that specific time period, and then summing them all up. This is literally the bedrock of discounted cash flow analysis. Yes, it's labor-intensive, but it is the absolute only accurate way to value the erratic heartbeat of a real business.
Section 5. Understanding growth rates. So the really crucial point here is figuring out what happens when our cash flows aren't just unequal, but they are systematically growing year over year. Enter the growth rate, which we just call G. Once our company has matured and stabilized, we expect our cash flows, or the dividends we pay out, to grow at a constant rate forever. This G represents the perpetual engine of a stable company. It's our ability to consistently raise prices, innovate, and outpace inflation over the really long haul.
And finally, Section 6, Valuing with Gordon Growth. This brings us all the way home to the ultimate question. How do we synthesize all of this to prove to the market what our equity is actually worth? If our company operates indefinitely into the future, it's going to produce an infinite stream of cash flows. But obviously, you can't type infinity into an Excel cell. We need a reliable mathematical tool to capture infinite future value and distill it into one single, justifiable price tag today.
To do this, we use the Gordon Growth Model. We just follow 4 precise steps to isolate the value of a mature enterprise. First, we project exactly what our cash flow will be next year. Second, we use that custom insurance policy we talked about earlier to determine our required rate of return, R. Third, we estimate G, our perpetual growth rate. And finally, we just divide.
Here is the model in all its elegance. Our present value simply equals next year's expected dividend, divided by the gap between our required return and our growth rate. It beautifully balances our expectations of risk against our expectations of growth. As long as our required return is higher than our growth rate, this one simple formula captures an absolute eternity of cash flows. But honestly, here is where theory meets extreme danger. Because the Gordon Growth Model relies on that tiny difference between our return and our growth rate, even a fraction of a percent tweak to either number will send your valuation absolutely skyrocketing or crashing down. So I want to leave you with this final thought. How secure are your assumptions? Are you rigorously stress testing your models, or are you just tweaking the math to get the valuation you secretly want? Keep these principles in mind, and you'll always know the true value of your time and your capital. Thanks so much for joining me for this explainer.